Financial markets have a habit of rewarding movement. Traders thrive on activity. Big price swings feel meaningful because they signal decisive action. In contrast, quiet periods, days when prices seem to stand still, are often ignored. Flat markets appear uneventful, unimportant, or even boring. Yet, sometimes the most critical developments happen precisely during moments of calm. Take silver, for example. After a significant rally, its price has settled into a narrow range around the low $60 level. Small upward or downward moves seem insignificant to many observers. They interpret the calm as exhaustion, indecision, or a sign that the rally is over. But price alone tells only part of the story. To truly understand market behavior, volume matters as much as price. Despite the narrow trading range, silver has experienced unusually high volumes. A high volume in a flat market is rarely coincidental. It often indicates that large amounts of supply are being absorbed. Absorption requires a determined, well-funded buyer. In other words, while price appears still, significant activity is underway behind the scenes. Attempts to push silver lower are consistently met with resistance. Sellers offer metal at slightly lower levels, but their attempts fail. This behavior suggests strong demand at current levels, a persistent buyer absorbing available supply rather than chasing short-term gains. Unlike retail traders, large institutions must operate differently. A small trader can buy or sell without moving the market, but an institution buying millions of ounces must manage the impact carefully. Market strategies like iceberg orders allow large buyers to operate stealthily. Only a fraction of the total order is visible at any time. Once filled, it replenishes automatically. To outside observers, demand appears limited, yet persistent. Volume rises steadily, while price remains anchored. These patterns are exactly what we see in silver today. Every attempt to move the price downward meets absorption, yet there is no dramatic rebound. This is not speculative buying. It is patient accumulation. Tens of millions of ounces may have been absorbed at current levels, representing hundreds of millions of dollars. Retail traders lack the resources to buy on this scale. Hedge funds rarely commit such capital without clear short-term opportunities. Bullion banks typically sell into rallies rather than support floors. The presence of a strategic long-term buyer becomes the logical conclusion. Such buyers are not chasing momentum. They prioritize securing supply. Weak-hand speculators hoping for quick gains often sell during small dips. The long-term buyer absorbs these sales quietly. Gradually, ownership shifts from short-term traders to participants with longer horizons. This creates a stable foundation for future price movements. Unlike previous speculative rallies, driven by hype and retail excitement, today's market is calm yet resilient. Earlier rallies collapsed when enthusiasm waned. Now, prices hold even without excitement, suggesting that demand is structural rather than discretionary. Some buyers may be obliged to acquire silver regardless of short-term conditions. Physical silver premiums rising, even as futures remain flat, further indicate that metal is being removed from circulation. Silver is no longer only a monetary or speculative asset. Its behavior now reflects industrial demand, particularly from sectors tied to electrification and technology. One major driver is the growth of an irrelated energy infrastructure. While AI itself is digital, the servers and systems powering it consume massive amounts of electricity. Expanding AI operations place enormous pressure on power grids, requiring direct investments in generation capacity. Solar energy is among the most scalable solutions for this demand. Modern high-efficiency solar panels use silver in conductive layers. Although silver content per panel has decreased over the years, large-scale adoption ensures overall demand continues to rise. From this perspective, silver becomes a critical industrial input. Strategic accumulation ensures supply availability, reducing the risk of shortages. Recent disruptions in supply chains have reinforced the importance of securing essential metals. Strategic stockpiling and vertical integration are increasingly standard practice. Silver used in industrial applications is unlikely to return to open markets. Once integrated into infrastructure, silver effectively disappears from tradable supply. Rising industrial demand reduces availability for discretionary or speculative use. Medical and defense sectors rely on silver and are relatively price insensitive. Jewelry and other non-essential uses become the marginal source of recycled metal. Recycling cannot rapidly offset surges in industrial demand. The imbalance between supply and demand can lead to sharp price movements when accumulated buying eventually encounters a thinner market. Historical trading data shows limited supply above current price levels. Once resistance is broken, prices can advance rapidly due to the scarcity of prior available supply. Calm markets often hide these critical accumulations. Investors focusing on short-term swings may underestimate the significance of a flat, high-volume market. Strategic accumulation quietly reshapes ownership, laying the groundwork for meaningful future moves. The biggest challenge in such a market is psychological. Flat markets test patience. They do not provide the instant gratification of rapid gains. Long-term accumulation differs fundamentally from speculative enthusiasm. Quiet markets often precede the most substantial changes in ownership and eventually price. Observers must look beyond visible price movements, paying attention to volume, physical premiums, and broader industrial demand trends. Silver today tells a story that many overlook. Price appears still, but beneath the surface, significant accumulation is occurring. Large buyers absorb supply, shifting ownership from speculative traders to long-term participants. Industrial demand, especially from solar and AI-related energy infrastructure, supports structural growth. Physical silver is leaving the market for critical applications, tightening supply. The lesson is clear. Markets reward observation, not just reaction. Quiet accumulation, high volume, and strategic positioning often signal more than volatility ever could. In silver, calm is not inactivity. It is preparation. And those who recognize the underlying forces are the ones who understand the market's future.